What is going on, guys? It is Aaron and Josh back for another Finance Friday, and in today's video we are going to chat about bond markets. I know it sounds boring, I know it sounds like your grandpa should be talking about it, but it is a very important topic, and if you're going to be using commercial debt, it's something you should actually fundamentally understand because there's a lot of strategy around it, and if you've gone through the process, you probably know what looking at the bond deals look like, and it can give you a ton of stress. So we wanted to give you some clarity on what that looks like, how it works, and how it affects your actual mortgage. So let's dive right into it, guys. Bond yields. So for anybody who doesn't know, bonds as a whole are government-backed guaranteed returns on investment. Specifically for what we're talking about today, something called the CMB, which is the Canadian Mortgage Bond, which is the bond that allows for lenders or CMHC to securitize mortgages, and then companies like hedge funds or sovereign wealth funds will purchase this as AAA debt with a guaranteed return on it. And the reason why they can get a guaranteed return on it is because it's insured. So, the bond markets really are forward-looking rate projections based on a handful of different variables. Now, those variables could be the wind blowing that day. They could be the orange man down south saying something. They could be geopolitical conflicts. Most of the time, it's Canadian economic data that's coming out. But I think it's important to understand, how these work and how they affect your debt. So essentially, how they work is, you have a whole layer of capital, which is kind of the base layer of capital. Bonds are issued by usually states or countries, and this is kind of the base layer of where everybody buys or is able to issue capital. So lenders or banks on a balance sheet would hold bonds for a guaranteed return and possibly even leverage them to be able to lend them out to you. So when it comes to using this type of debt, or at least understanding the debt, bonds will move based on the difference of something changing. So for example, if economists are all of the same opinion that we're going to have 10,000 jobs next month, and then we get those 10,000 jobs, bonds aren't going to move because it's of consensus of where the bonds are already projecting, because bonds are forward looking as to where rates are going to be on a certain period of time. Now, if you have turbulent economic times or something that comes out of the left fields, like a black swan event, those are situations where you have massive variances in bond yields. They start to move, in significant ways. And this could actually make a fundamental impact on the debt that you're looking to take. So let's dive into how that actually works.
Yeah, so as Josh said, all of your pricing around CMHC specifically, but also just commercial debt in general, is all based off some sort of bond. The Canada Mortgage Bond is the CMHC asset tool for non-banking lenders. You do have big five banks and other lenders that are able to lend off of the GOC or their cost of funds, which again are all bond derived. So how do these bonds move and what does it do to your project? So if you're taking a look at the economy, and as the economy starts to get worse, you're going to start to see bond prices fall down. As the yield reduces, the lenders have to find a way to be able to attract people to come in to buy the bond, and therefore they reduce the price of it, and that's what's going to make that more attractive. It also helps your bond pricing on the CMB and your contract rate in a benefit way, because obviously your price is based off of some sort of base price of the bond, whether it's GOC, whether it's the CMB, and then plus a spread. So economy getting worse, bond prices decrease, your overall spread and general just gross contract rate starts to decrease, which is obviously good for you in a sense, but also not necessarily great for the overall economy of the world, which I think it's kind of funny when people are always complaining about other rates aren't low enough, but hand in hand with that, it means the lower the rates, the worse off the entire world and the economy is for the most part. So, this is why I think we talk about in a lot of our videos, just things that you should be paying attention to as an investor, what's going on in the world in terms of socio-political conversation, down the States, in Canada, across in Europe as well too, what's going on with the oil reserves, what's going on with lumber, steel, all these trades and stuff like that, right? Because it's all indicators of how the world is moving, therefore all indicators of what's going on in the economy, and a pretty good indicator of what's going to happen with the bond prices. The job market is another thing as well too. Are we up in jobs? Are we down in jobs? So these are all types of indicators that are going to point to how your bonds are moving. When we're taking a look at specific pricing for CMHC and on the CMB, you're going to have your base bond. Today, we're taking a look at a 5-year. The base bond price is 3.25%. Depending on the size of the deal, the lender is going to essentially benchmark their spread on the deal, and that's going to give you your contract rate. So on a $2 million deal, you might have a 5-year CMB at 3.25 plus maybe 85, 90 basis points depending on the lender. When you take that 3.25 and you add your 85 bip spread, that's going to give you a 4.1% interest rate. So that's what we're looking at as your actual potential contract rate for your mortgage. Now, a few things to keep note here. Because the bond market is live and your closing date is subject out, the lenders aren't going to give you a rate lock right away. So this is just basically a quote on where your price is going to be. Your spread, which is at 85 bips, that's going to be locked in for essentially the entirety of your deal. So if you're closing in 3 months, you're pretty much guaranteed to get that 85 bip spread. What you're not necessarily guaranteed to get is the base bond price as of today. The bond could go up, the bond could also go down. So that's something that we have to take a monitoring on during the course of the transaction. Us as the brokers, we'll be making sure that you're up to date, whether it looks like your rate's going to be falling or whether you're going to get into some sort of like increased rate, which could in theory produce like a buy down situation. And we're taking a look at like buy downs and how that works. When we underwrite the deal, we're going to take a look at what's your contract rate potentially going to be, but also how much room is there in the deal and what does that look like at your ceiling rate. Obviously, as the bonds start to move throughout the lifetime of the deal, it does put stress on your ceiling rate potentially if the bond prices are increasing. So going back to our example, if our contract rate was 4.1 and we underwrote a deal and the ceiling rate was 5%, well, obviously it's pretty safe. There's about 90 bips of spread there. In most economies and in most deals over a 3-month period, you're probably gonna be pretty safe. If your contract rate on the other hand was 4.1, but your ceiling rate was like 4.25, 15 basis point spread in a 3-month average in today's market isn't really a safe spread. So again, that's where it comes down to like understanding what's going on in the economy, how that affects your bonds and what that's going to do your pricing at the end of the day, because again, we don't do a rate lock on your CMHC deal until usually a few days before close. So on a 3-month, potentially a 5-month transaction, obviously the risk there for your deal and for the bond on your pricing to be able to change is at much greater risk.
Yeah, I think that opens up the conversation for strategy around like what to submit your file at. So most people who are looking to take on a product like CMHC, they're taking on for a few different reasons. One being, leverage, so they're taking like higher loan to value or, extended amortization. So a lot of the times when we're running numbers for our clients, they'll be like, okay, well, what, rate do I need to submit my file at to be able to get my 85% loan to value? And a lot of the times, especially in today's elevated markets, you're going to have a lower max rate than probably what you're locking in today, at least in Ontario for. So let's say for example, you need to have a 3.75% submission rate to be able to get your 85% loan to value. But using Aaron's example, if we were to fast forward and lock in the rate today, it's 4.1%. We have a buy down situation. The difference between that 3.75 and that 4.1, that difference you have to pay throughout the term of the loan. Now it is discounted, but when you're looking at taking on this type of debt, it's understanding the strategy around what does that mean for me? Well, if I can maximize my qualifiable loan amount at a 3.75% submission rate, I'm getting the maximum amount that the product is going to allow me to get. Now, am I taking a risk? Like I'm reducing my down payment because I'm only 15% down, but if I calculate it, the difference, my buy down, I do have an increased down payment, but not the same amount that you would have dollar for dollar. A buy down calculation is actually discounted from, it's not dollar for dollar on what the spread is. So you actually are ahead by submitting at, essentially the lowest max rate possible to get your leverage because you have a discounted rate. So, if you were to essentially to increase that to 4.1%, your loan amount or down payment change by 300 grand, you would actually have a buy down of maybe like 170 or $200,000. So you'd be ahead slightly, but it's important, I guess what I'm getting at is to understand the intricacies and strategy around actually submitting this. So if you submit at a low max rate, you can't necessarily like go and submit at, like, you go and change the max rate if rates drop to be able to increase your loan amount. So the loan amount that you submit at to CMHC stays consistent throughout the entire term of the loan. There's technically strategy around looking into the future, asking your brokers or understanding the debt cycle or like where you expect things to go in the next 4 to 6 months, because you might be rolling dice on projecting if bonds are going to go down. Like, you're guaranteeing your rate and you're guaranteeing your loan size, but maybe you're projecting that rates are going to go down in 3 to 6 months. And then in that case, you're not going to have as much of a buy down, but you're still going to be able to achieve, that low down payment amount for that acquisition. So there's a lot that goes into looking at, where bonds are going and where we expect things to happen. But it's not just a clear cut, what's going to happen with the economy. A lot of it has to do with geopolitical conflict and issues globally. Now, this isn't just walk into a bank and, get here's your mortgage and your fixed rate. Like, things do change. So, when you're looking at submitting, especially on large deals at low max rates to maximize the total net loan amount to you have an understanding of where that is and how it's going to affect your net equity in a deal, whether it's a purchase or whether it's a refinance. Now, if it's a purchase, that got additional cash to come up on closing. If it's a refinance, it comes from your net proceeds back to you. So you get just less proceeds back and you're essentially maximizing your cash flow. Another strategy is submitting at a lower max rate and taking the buy down to just have more steady low cash flow at a lower rate than you would normally have on the market today. So the bond markets as a whole, they usually are supposed to be pretty level. Like, you're not supposed to have massive variances in yields. Over the last 2-3 months, that has not been the case. And we saw a run up of 40 basis points in less than a month. We then saw a decrease of 25 basis points when we had a stay with the Iranian war. And then we're seeing a resurgence again back up. We're seeing double digit, basis point increases in a day, which isn't necessarily consistent, but, it does pose a risk when you're looking at either locking your rate or closing your rate. On a refinance, your COI is good for 6 months. So having the conversation once a COI is issued around strategy and whatnot is really important. On a purchase, it can be a little bit tighter because you're really at the mercy of the market, but just having a fundamental understanding of needing additional liquidity to be able to take on that purchase, or just a realistic expectation of your net proceeds is probably the most I say pivotal important thing to understand when we're taking on this type of debt in today's market.
Yeah, I think the next thing we kind of want to touch on is just taking a look at picking your lender and understanding what options are potentially available on your CMHC loan specifically. So I think we mentioned a little bit earlier in the video, the CMB is really allocated for non-banking lenders. So these are your major lenders that aren't the big banks. They're not a TD, they're not a BMO, they're not an RBC type lender. That's the kind of debt that they get allocated on the bond market. When we're working with lenders such as like RBC or TD, they do have the option to be able to work off of pricing either based on like their own cost of funds or on the GOC. It really kind of depends to them. Also may depend on your size of your loan or whether or not you have some sort of like social scoring, specifically more so on the affordability side, because lenders tend to look a bit more favorably on that. Now, why does this matter? So if you take a look at like the historical differences between where the government of Canada, the GOC bond is at versus where the CMB is at, usually there's like somewhere between like a 15 to 20 basis point spread. The GOC is slightly cheaper just at the base bond price and where it's being advertised at. So in theory, if you're able to get a lender that's lending based on the same amount of basis point spread, call it like 70 points, based on like whether you're lending on the GOC or on the CMB, that same basis point spread is going to yield you a lower net contract rate on the GOC than it would on the CMB. So again, like choosing your lender and who you're working with and understanding how they price their deals and what type of bond are they lending off of can definitely be a strategy to be able to help result in just like overall net cheaper pricing. I think also just understanding where the lenders are pricing different loan sizes at makes a huge difference. Your best pricing or your better pricing really starts probably more around like the 5 million up, definitely getting towards like the 8 million up. Obviously anything 10 million above is really going to start to get you into like your better pricing, where you're looking more into like the 45 to like 55 basis point spreads, which is really starting to get like as cheap as you can get into that debt. But for example, just to talk about like cheapness of debt and being quoted, like talking to a big bank lender, the cheapest that they could go on their own like cost of funds was like 30 basis points. So like it really comes down to a few things of obviously understanding like what is being advertised to you and what the price is. The CMB and the GOC are often, or not often, but they are like publicly available pricing. You can go on any sort of like financial institution's website, take a look, and there's a pretty accurate live rate there. The one thing that you're not going to be able to get from a public standpoint is cost of funds from a lender. So that is one of the challenges, is understanding how are the cost of funds moving on a day-to-day or month-to-month basis within a lender. Again, with it not being like a live pricing metric that you can just go on and look, you're not really fully subject to disclosure from that lender as to how that pricing is moving. The bond rates might be coming down, but a lender's cost of funds may not move because of the way that the metrics are decided. How a lender is borrowing their cost of funds specifically might be a little bit different than just taking a look and following the live bond market. So a potential negative there is just, that disclosure availability from the lender versus like watching a live market play out in certain economic standpoints. But again, like there is different pricing strategies depending on the size of the loan and what you're able to get from these lenders depending on who you work with.
Yeah, and I think it's important to understand like the big banks are looking for like much larger loan sizes. So if you're in that like smaller development or construction size, it's very difficult to be able to attain that like that cost of funds like rate if you are just getting into it or just have a smaller project as a whole. But it is important to note that there are different like price metrics that you can price your loan at depending on the quality of borrower that you are as a whole. Something also to understand is like there are different term lengths for bonds, and these term lengths actually coincide with the term length of your mortgage. So with the CMB, for example, it's a 5-year or 10-year term. These two term lengths, they actually trade at a significant difference or spread. So we're usually roughly around 50 basis point difference from the 10-year to the 5-year. Now the 10-year, people ask it, why would you take a 10-year term? Well, a 10-year term, provides guaranteed rates over a prolonged period of time. A lot of like institutions or brand new developments will take a 10-year term just because, they have very little rental upside and, they have more risk with renewal when on a 5-year than they do a 10, so they can give themselves enough time to be able to increase rents. A lot of applications right now are going with the 5-year term, and there are some challenges depending on the time of the year from lenders who have certain levels of allocation. Sometimes obviously the 5-year just goes really quickly because the qualification rate required to take on a 5-year is less. So depending on where you're at from a time perspective, where the lenders are at, the size of your loan, and where you're at with like the development cycle of your loan or your development has a lot to do with what term you're going to take, which bond you're going to take, what sizing of loan you're going to have, the pricing you're going to have. So when people say, oh, I'm getting CMHC financing, and your buddy down the street who did a $10 million deal had got a smoking deal, but you have $1.5 million deal, you're not going to have the same pricing. You're not going to be able to get the same like level of financing that those larger projects have. Fundamentally, this product is an institutional product. A lot of the time it is made for those like larger borrowers. So the spread on that isn't necessarily as advantageous as maybe talking to a larger developer who got a great deal on their financing. All right, guys, I hope we didn't bore you. I hope that you got a lot of information out of this. We know it's a little bit complex. We know sometimes, if you're not in the industry, it can go way over your head. But the idea is just to keep you guys informed and to understand how this debt actually works and how it's going to affect your deal if you do want to take this type of debt. If you do have any actual questions about, your specific mortgage or taking on one of these mortgages, reach out to Ehren and myself. We're happy to just dive into what exactly that looks like for you and how it's going to affect your specific deal. If you did like this video today, hit the subscribe button, hit the like button. It allows us to make more videos like this for you guys. Until next time,